Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. U.S. stock market, NFLX 8-day drop, ISRG, TSLA, AMZN, NVDA, MSFT support levels, AVGO guidance miss, and CRW pullback. This video presents a direct informational narration of the source document. At the time of this report, all four major indices experienced declines. The S&P 500 actually halted its 9-day winning streak, stopping just short of breaking a historical record set way back in 1985. Meanwhile, the Russell and Dow Jones indices saw the most significant drops.
Looking at the specific sectors, the source notes that energy and healthcare performed exceptionally well. On the flip side, consumer discretionary, financials, and technology were the ones lagging behind. Shifting to geopolitical developments outlined in the document, we've seen mutual strikes between the U.S. and Iran, which immediately drove up oil prices. Specifically, the U.S. struck Iran's Qeshm Island, while Iran claimed to have attacked a U.S. Naval Command Center in Oman, though U.S. Central Command denied that claim. On top of that, Kuwait International Airport was attacked. The report also mentions former President Trump stating the U.S. was reaching an agreement with Iran to abandon nuclear weapons development. That news briefly narrowed oil's gains. However, Iran's foreign minister later clarified that while channels are open, no substantial progress has been made.
On the economic front, the data shows ADP employment rising from 109,000 to 122,000, which came in above the expected 117,000. Interestingly, the quits rate dropped just slightly, going from 6.6% to 6.5%. Then we have the U.S. May ISM non-manufacturing PMI, often called the services PMI. It increased from 53.6 to 54.5, exceeding the 53.8 estimate. Within that PMI data, the Business Activity Index climbed from 50.9 to 57.7, and the New Orders Index rose from 53.5 to 57.3.
Now, despite those figures, the prices paid index remains stubbornly high at 71.3, up from 70.1. According to the document, service sector respondents noted rising inflation pressures. These are driven by higher fuel, energy, and tariff-related costs stemming from Middle East tensions. Suppliers are increasingly passing on these higher transport and raw material costs. With supply chain delays now appearing in the construction, technology, and energy sectors, the report concludes that inflation is slowly rebounding. This makes the prospect of rate cuts, as originally expected, highly unlikely.
Moving on to corporate earnings, the source document highlights Broadcom's Q2 results. Their revenue grew 48% to $22.2 billion, coming in slightly above the $22.1 billion expectation. Breaking that down, AI semiconductor revenue hit $10.8 billion, exceeding the $10.7 billion estimate. This specific category includes custom accelerators for AI models and networking semiconductors. Also, adjusted earnings per share reached $2.44, beating the $2.39 midpoint estimate.
However, the report points out that the real issue lies in their forward guidance. For Q3, AI semiconductor revenue is projected at $16 billion. That's lower than the market's $17.2 billion estimate. And while the total revenue guidance of $29.4 billion is technically above the $28.6 billion midpoint estimate, it still sits below the highest buy-side institutional estimates. Ultimately, the guidance for their core custom chip business missed the mark. Looking ahead to the full fiscal year ending January 2027, Broadcom maintained its $100 billion chip sales target, along with its 10G AI capacity target. But unlike previous quarters, they didn't revise their earnings expectations upward. The document notes this indicates less certainty for the remaining 2 quarters. Furthermore, the report highlights rising margin pressures. This is because the growth of the Google TPU custom business brings lower profit margins compared to Broadcom's networking and software businesses. This situation actually highlights broader macroeconomic concerns for the technology sector. While Broadcom has long-term agreements with companies like Google, recognizing revenue each quarter versus managing a multi-year backlog remains a question mark. The top 4 tech companies are converting almost all their free cash flow into AI capital expenditures through 2026. If their 2027 revenue and free cash flow growth can't match this massive spending, they'll be forced to issue debt. So the source emphasizes that validating AI monetization to justify these expenditures is absolutely critical, because if spending slows down, the entire downstream supply chain will be affected.
To build context on how the market is pricing these assets, the document compares Broadcom with Marvell,
Broadcom's current price aligns with its fiscal year 2026 upper estimates, though it hasn't quite reached 2027 levels yet. This indicates the market is pricing roughly 6 to 12 months ahead. If we look back at the AI acceleration phase in 2024 to 2025, Broadcom's price surged nearly 100% based on its strong fundamentals as a custom chip leader, whereas Marvell traded mostly flat during that same year.
But here's where the document points out a significant shift in current market dynamics. It states that recent rapid price increases in certain stocks are not being driven by improved fundamentals. Instead, short-term capital is focusing on liquidity, momentum, small float, and rapid short squeezes. The takeaway here is that overall market conditions right now are dictated by capital flows and sentiment rather than fundamentals or reasonable valuations.
Speaking of momentum, let's look at CrowdStrike. The report shows a strong Q1 with an adjusted EPS of $1.10 on $1.39 billion in revenue, both of which beat estimates. Looking forward, their fiscal 2027 revenue guidance was raised to a range between $591 and $596 billion, and EPS guidance was bumped up to between $498 and $496.
Additionally, CrowdStrike's board approved a 1-for-4 stock split. As the source notes, this is a purely mathematical move that drops the share price from the $700 range down to the $100 range. It doesn't change company fundamentals or shareholder equity at all. What it does do is increase liquidity, making the stock more accessible for smaller portfolios and lowering the entry cost for options trading.
The source analysis also issues a warning regarding the upcoming SpaceX listing. With an exceptionally high 1.75y valuation and potential $135 pricing, the report points out that this play is based on low float and restricted circulation, rather than pure fundamentals. The concern is about capital rotation. Speculative capital, particularly highly profitable funds currently sitting in rapidly rising stocks, is expected to rotate out of existing tech names and concentrate heavily on this new listing.
Moving to individual technicals analyzed in the document, Netflix broke below $87, falling for 8 consecutive trading days. That makes it the longest losing streak for the stock since November 2022. Based on this, the outlook points to a new cost control target zone between $60 and $77. The source specifically notes that stabilization below the $77 mark is a key technical level to watch closely.
As for Intuitive Surgical, the stock touched $396, entering a wide $80 accumulation range between $321 and $405. Historically, this stock commanded high multiples of 40 to 50 times during its 20% growth periods. But as growth slows, the report explains that its valuation multiple is compressing toward 30 times. This makes prices around the $300 mark more fundamentally grounded, with technical support heavily situated between $258 and $295.
Over to Tesla. The document notes the stock is testing a critical upward trend line. It absolutely must hold the 419 to 428 range to prevent a downward expansion. If the price falls below the 404 to 405 level, it breaks that trend line significantly. That breakdown would trigger quantitative selling and increase downward pressure. For now, volume remains low, which is keeping the stock in a slight holding pattern. Checking in on Microsoft, the report indicates it has reached its targeted support at $375. This is flagged as a key support level, though upcoming mid-June Federal Reserve events do introduce near-term market variables. Meanwhile, Amazon hit its aggressive entry target zone of $244 to $256, a more conservative technical entry targeting fiscal year 2027 safety margins sits below $224, closer to $219.
In the semiconductor space, the document shows NVIDIA testing a small support zone between $208 and $218. Interestingly, decreasing volume here is highlighted as a positive sign for technical repair. AMD, on the other hand, continues to show strong momentum, pushing to new highs. In the payment sector, MasterCard saw a slight rebound, with the report identifying long-term cost targets in the $500 to $700 range.
Now looking at the IGV ETF, which tracks the broader software sector, the report confirms a breakdown below $101, interrupting its upward momentum. It's now entering a consolidation range between medium support at $90 and strong resistance at $107. Despite this near-term action, the broader structural macro uptrend remains intact as it gathers strength for the next move. Finally, circling back to that impending liquidity drain expected from the low-float SpaceX listing, the core question presented by the source report is this: will the broader tech market be able to withstand the anticipated capital rotation once this new listing goes live?